Okay, okay. Okie dokie. Okie dokie, okie dokie. For many corporations engaged in international operations, management activities may be conducted in several countries. Management activities may be conducted in several countries during any particular taxable year. As a result, the place of management test is less certain in its application than a place of incorporation test, at least in theory. In practice, most countries use that test employ practical tests, such as the location of the company's head office, or the place where the board of directors of the company or the equivalent body with ultimate responsibility for and control of the affairs of the company meets. To determine the place to, de- to determine the place of management, the place of management test is used by the United Kingdom, UK, and many of its former colonies. Some countries, such as Australia, Canada, and the UK, use both the place of incorporation test and the place of management test. A place of management test is easily exploited for tax avoidance purpose. A place of management test is easily exploited for tax avoidance purpose, where a change in the place of management can be accomplished without triggering any tax. Assume, for example, the ACO is a corporation resident in country A, which uses a place of management test. ACO has developed valuable intangible property it intends to license to taxpayers located in country B. ACO has developed valuable intangible property that it intends to license to taxpayers located in country B. To avoid tax in country A on the expected royalties. ACO shifts its place of management to country H, a low tax country. The large occurred gain on ACO's intangible property is not taxable in country A because no transfer of that property because no transfer of that property occurred. However, as discussed in Chapter 3, several countries have adopted exit or departure taxes to prevent taxpayers from avoiding tax by changing their residence. ACO then licenses the technology to users in country B. The royalties received by ACO escape taxation in country A because ACO is no longer resident in country A. So ACO changed its place of management to country H. So ACO is no longer a resident of country A. So that the royalties cannot be taxed. If country A above example used to use the place of incorporate test, ACO could not transfer its residence to country H without undergoing a corporate reorganization that would probably result in transfer of its assets to a corporation organized in country H. Such a transfer would trigger a realization of occurred gain on the intangible property, thereby limiting or even eliminating ACO's opportunity for tax avoidance. Countries that use the place of incorporation test exclusively, such as the U.S., have encountered avoidance schemes have encountered avoidance schemes called corporate inversions, whereby resident multinationals are reorganized to avoid or take advantage of certain aspects of the residence country's tax system. Although inversions take many forms and invariably quite complex, the following simplified example illustrate illustrate illustrate
Illustrates.
illustrates. Simplified example illustrates a general idea. Assume that USCO, a widely held US-based multinational. Assume that USCO, a widely held US-based multinational, wants to avoid the effects of the US CFC rule. To do so, it establishes a subsidiary focal in a country without CFC rules, and then arrange for its shareholders to exchange their shares of USCO for shares of focal, and for the shares of all USCO's foreign subsidiaries to be transferred to focal. The end result is that focal is not a CFC in respect of any of its US shareholders, and the US CFC rules are no longer applicable to USCO because its foreign subsidiaries have become subsidiaries of focal. Many commentators argue that the proper purpose of the corporate tax corporate tax is to impose tax burdens on corporations' individual shareholders. Many commentators argue that the proper purpose of the corporate tax is to impose tax burdens on corporations' individual shareholders. According to this view, the corporate tax is paid in advance on behalf of the individual shareholders. According to this view, the corporate tax is paid in advance on behalf of the individual shareholders of the corporation to prevent them from deferring tax by investing in corporations. According to this view, the corporate tax is paid in advance on behalf of the individual shareholders of the corporation to prevent them from deferring tax by investing corporations. Otherwise, the individual shareholders would not pay tax on the income earned through the corporation until they receive dividends or sold their shares. Therefore, the test of residence of a corporation might be determined, at least in theory, by reference to the residence of its shareholders. Therefore, the test of residence of a corporation might be determined, at least in theory, by reference to residence of its shareholders. However, the application of residence of the shareholders test will present serious problems when residents of more than one country hold large blocks of stock in a company, or when the stock of the company is publicly traded, and the identity of the shareholders is difficult to determine. Taking this view to its logical conclusion, in effect, corporations would have to be taxed like partnerships. Corporations would have to be taxed like partnerships, with each country taxing the shares of the corporate income attribute attributable attributable to its resident shareholders, with each country taxing the shares of the corporate income attributable to its resident shareholders.
Attributable.
Attributable to its resident shareholders. For legal entities other than corporations, residence is generally determined under either a place of organization test or a place of management test. Determining the residence of a partnership is sometimes difficult because of the informality with which a partnership can be established. For example, in some countries, a partnership may be created by virtue of the course of conduct.
Virtue.
May be created by virtue of the course of conduct of the relevant parties without the necessity of any formal legal documentation.
Necessity.
Of any formal legal documentation. In many countries, partnerships are treated as transparent, or flow-through entities for tax purposes. In other words, the partnership are taxed on their share of the income of a partnership, but a partnership itself is not taxed. For these countries, the residence of a partnership is usually irrelevant because the partnership is not a taxable entity. Difficult problems can arise under the laws of some countries in determining the residence of trusts. Trusts.
Trusts.
These problems are especially difficult when the country of organization, the country where the trustee or trustees are resident.
Trustee.
Trustee or trustee are resident. The country where the grantor or shelter.
Grantor.
Shelter. Grantor, shelter. Settler. The grantor or settler is located. And the countries where the beneficiaries are located are all different.
Beneficiaries.
Beneficiaries. Beneficiaries. Difficult problems can also can arise under the laws of some countries in determining the residence of trusts. These problems are especially difficult when a country of when when the country of organization the country where the trustee or trustees are resident, the country where the grantor or settler uh, settler is located, and the countries where beneficiaries are located are different.
Beneficiaries.
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 Beneficiaries. Beneficiaries.
Beneficiaries.
Beneficiaries.
Beneficiaries.
Beneficiaries. Beneficiaries. Beneficiaries. Treaty issues relating to residence. Treaty issues relating to residence. Under Article 4.1 of the OECD Model Treaty, a resident of a country for purposes of the treaty is a person who is liable to tax in that country by reason of his domicile, residence, place of management, or any other certiorari criterion of a similar nature. Article 4.1 of the UN Model Treaty as place of incorporation. To the list of connecting factors. To avoid situations in which an individual is considered to be resident in both countries. Article 4.2 of both models provides a series of tiebreaker rules. To make tiebreaker. A tiebreaker rule provides a series of tiebreaker rules to make the individual resident is only one country for purposes of the treaty. To avoid situations in which an individual is considered to be resident in both countries. Article 4.2 of both models provides a series of tiebreaker rules to make the individual resident is only one country for purposes of the treaty. The first tiebreaker is the place where an individual has a permanent home The second is the country. The second is the country in which the center of the individual's vital interests is located. The third is the place of the individual's habi, habitual dwelling, dwelling, habitual,
Habitual.
habitual, habitual dwelling.
Habitual.
Habitual dwelling. Habitual dwelling. Habitual dwelling. Okay.
Habitual.
Habitual, habitual, habitual.
Thus live our life, that these thoughts are repetitive and habitual, but that's also
Habitual.
why it's so easy. Thus live our life, that these thoughts are repetitive. What you see from continued habitual use for heavy users that
Habitual use, habitual dwelling. The first tiebreaker is the place where an individual has a permanent home. The second is the country in which the center of the individual's vital interest is located. The third is the place of the individual's habitual dwelling. And the fourth is the country's citizenship. If these tiebreakers rules are ineffective in making an individual a resident of only one country for treaty purposes, the competent authorities of the two contracting states are mandated to determine residence pursuant residence pursuant.
Pursuant.
Pursuant. Residence pursuant of the two contracting states mandated to determine residence pursuant to the mutual agreement procedure in Article 25 of the OECD and UN model treaties. Most modern tax treaties follow the tiebreaker rules for individuals in the OECD and UN model treaty closely. For legal entities resident in both contracting states, until 2017, the tiebreaker rule in Article 4.3 of the OECD and UN model treaties provided that the entity was a resident of the country where its place of effective management was located. According to the prior commentary on Article 4, the place of effective management of an entity was the place where key management and commercial decisions are in substance made. As a place where decisions making at the highest level on the most important issues of management takes place. Moreover, according to the commentary, an entity could have only one place of effective management, although it could have multiple places of management. For legal entities resident in both contracting states until 2017, the tiebreaker rule of the treaty provided that the entity was a resident of the country where its place of effective management was located. Effective management was located. The place of effective management tiebreaker rule was often difficult to apply, was not viewed favorably by many countries. And was not used in many bilateral treaties. Bilateral.
Bilateral.
Bilateral. And was not used in many bilateral treaties. Most dual resident entities are used for tax avoidance purposes. For example, a dual resident company with losses would be entitled to relief for such losses in both countries in which it is resident. Therefore, many treaties provide that a dual resident entity is not considered to be a resident of either country for most treaty purposes. As a result, such an entity is not entitled to any of the benefits of the treaty. The place of effective management tiebreaker rule was often difficult to apply. Was not viewed favorably by many countries, and was not used in many bilateral in many bilateral treaties. Most dual resident entities are used for tax avoidance purposes. For example, a dual resident company with losses would be entitled to relief for such losses in both countries in which it is resident. Therefore, many treaties provide that a dual resident entity is not considered to be a resident of either country for most treaty purposes. As a result, such an entity is not entitled to any of the benefits of the treaty. In 2017, Article 4.3 of both OECD and UN model treaties was amended to provide that competent authorities shall endeavor shall endeavor to establish the residence of a dual resident legal entity, taking into account its place of effective management, place of incorporation or creation, and other relevant factors. If the competent authorities cannot agree, the entity is not entitled to any treaty benefits except to the extent agreed by the competent authorities.
Competent.
Competent. Competent. In 2017, Article 4.3 of both the OECD and UN model treaties was amended to provide that competent authorities shall endeavor to establish the residence of dual residence legal entity, taking into account its place of effective management, place of incorporation or creation, and other relevant factors. If the competent authorities cannot agree, the entity is not entitled to any treaty benefits except to the extent agreed by the competent authorities. The U.S. insists on its inclusion in its tax treaties of what is commonly referred to as a saving clause. Saving clause.
Clause.
It's commonly referred to as a saving clause, and sometimes mistakenly referred to as a savings clause. The typical saving clause provides, with some exceptions, that the U.S. reserves the right to tax its residents and its citizens as if the treaty had not come into effect. For example, the U.S. citizen resident in a treaty country is not entitled to the reducted rate of withholding provided in the treaty on dividends received from the U.S. For example, a U.S. citizen resident in a treaty country is not entitled to the reducted rate of withholding provided in the treaty on dividends received from the U.S. In 2017, the OECD and the UN model treaties were amended to include a similar saving clause in Article 1.3, providing that subject to certain exceptions, this convention shall not affect the taxation by a contracting state of its residence. Source jurisdiction. By international custom, a country has a primary right to tax income that arises in has its source in its sourcing or is derived from that country. Derived from, sourcing, arises in sourcing or derived from that country. At least sourcing.
Source in.
Arises in.
Arises in.
And is derived from. As discussed in Chapter 3, under international custom, the country of residence is generally expected to provide relief from double taxation where its residence jurisdiction overlaps the source jurisdiction of another country. The country of residence is generally expected to provide relief from double taxation where its residence jurisdiction overlaps the source jurisdiction of another country. Residence, the country of residence is generally expected to provide relief from double taxation where its residency jurisdiction overlaps the source jurisdiction of another country. In other words, the country in which a taxpayer is resident has only a secondary right to tax the taxpayer's income that is derived from or sourced in another country. Most tax treaties provide that the country in which income is sourced has the first right to the tax that income, and that the country of residence has an obligation to eliminate double taxation of that income. Has an obligation to eliminate double taxation of that income. Although tax treaties give a country the first right to tax income sourced in the country, they usually provide that the source country must limit its rate of tax on certain categories of investment income, and also preclude preclude
Preclude.
preclude preclude
Preclude.
preclude
Becomes easier, and it doesn't have to preclude being super successful and hitting big and making money and all those things. Those things.
I was not thought of in the 40s, then I think you could actually preclude these kinds of things. So I was not thought of in the 40s.
The custom genome doesn't preclude internal experience, it just provides another way to understand. A custom
preclude. Also preclude the source country from taxing certain categories of income, even where the income arises in the country in the source country. Source jurisdiction. By international custom, a country has a primary right to tax incomes that are resident in, has its source in or is derived from that country, as discussed in Chapter 3 under international custom. The country of residence is generally expected to provide relief from double taxation where its residence jurisdiction overlaps the source jurisdiction of another country. In other words, the country in which a taxpayer is resident has only a secondary right to tax the taxpayer's income that is derived from or sourced in another country. Most tax treaties provide that the country in which income is sourced has the first right to tax that income, and that the country of residence has an obligation to eliminate double taxation of that income. Although tax treaties give a country the first right to tax income sourced in the country. Although tax treaties gave a country the first right to tax income sourced in the country, They usually provide that the source, the source country must limit its rate of tax on certain categories of investment income, and also preclude the source country from taxing certain categories of income, even where the income arise in the source country. Despite the priority given to source jurisdiction, the concept of source is rather poorly developed in domestic tax legislation and tax treaties. Despite the priority given to source jurisdiction, the concept of source is rather poorly developed in domestic tax legislation and tax treaties. Unlike the term residence, the term source is not used or defined explicitly in domestic law or tax treaties. Defined explicitly.
Explicitly.
Explicitly in domestic law or tax treaties. As a result, source rules are usually implicit. Source rules are usually implicit in other rules. Implicit. Implicit. As a result, source rules are usually implicit in other rules. For example, withholding tax imposed on amounts paid by residents to non-residents has an implicit source rule that such amounts are sourced in the country if they are paid by a resident of the country. Withholding tax imposed on amounts paid by residents to non-residents has an implicit source rule that such amounts are sourced in a country if they are paid by a resident of the country. There is a resident of country A and a non-resident of country A. The resident is going to pay something to non-resident. Implicit source rules that amounts, such amounts are sourced in a country if they are paid by a resident of the country. Most countries have only sketchy rules. Sketchy rules. Most countries have only sketchy rules. Only have sketchy rules for determining the source of income, especially income derived from business activities. For example, in the UK and the countries that were former UK colonies, income from business activities is considered to have its source where the real business is carried on. Such a rule is too vague to provide any meaningful guidance to taxpayers or tax officials. The OECD and UN model treaties provide a mixture of implicitly source rules and rules that function effectively as source rules. The OECD and UN model treaties provide a mixture of implicitly source rules and rules that function effectively and rules that function effectively as source rules. For example, under Article 11.4, interest income is taxable by the country in which the taxpayer is resident. And under Article 6, income derived from immovable property. Income derived from immovable property, including income arising from the operation of a mine or oil or gas well, is taxable by the country where the immovable property is located. However, the OECD and UN model treaties do not contain any explicit source rules for business profits. Under Article 7, business profits derived by a resident of one contracting state are taxable by the other contracting state only where the resident carries on business through a permanent establishment located in that other state, and only to the extent that the profits are attributable to the PE permanent establishment. This rule is the functional equivalent of a source rule. In general, under Article 5 of OECD and UN model treaties, PE is defined to be a fixed place of business, such as an office, branch, factory, or mine, and also includes a person acting on behalf of another person, a so-called dependent agent PE. In some circumstances, however, these rules are subject to several exceptions and special provisions. For additional discussion of the determining of a PE for purpose of tax treaties, see Chapter 8. Some provisions of the OECD and UN model treaties, such as Article 21, other income, contain general wording that refers to income arise in a contracting state.